Mr. Nissan Joseph, CEO of Metro Brands Johnson, right now on the show. Mr. Joseph, good having you. Thanks for joining in. Before I talk about the quarter per se, Mr. Joseph, would love to understand from you where or what is your view on this whole conversation that is coming up about the urban versus rural demand. Suddenly, with companies like HUL and Nestle talking about different categories, albeit, but talking about how rural demand is picking up, but urban is waning. It's set the cat amongst the pigeons. I would love to know your views here, sir.
Oh, thank you, Neeraj, for having me this morning. We don't look at it as urban versus rural because, the recovery was different if you go back post-COVID. What you're seeing post-COVID is a lumpy recovery, right? And in a good way, too. So we had a great year, the year after COVID, then everybody had a little bit of a challenge. So when it recovers and the economy tends to normalize, well, consumption tends to normalize, it's not a straight line recovery or normalization. It tends to be a little bit lumpy. What we're really happy about, though, is that the fact that two things. One is our Q2 numbers saw an improvement over our Q1 as far as year-to-year growth. That's number one. Number two, we continue to maintain our profit percent, though we did not have the revenue growth, which shows that there's some strong operational and financial discipline inside our organization. Right? The other point I want to point out is that in Q2, we have Crocs does extremely well. So that's on the tailwind side, and because of the monsoons, and it did very well for us over the monsoon season. On the headwind side, we had to liquidate some of our inventories in Fila and take some accruals for that inventory, that last bit of inventory that's left over, that depressed the margins a little bit. It is also a quarter where we have the end of season sale, so you don't have an upside of a lot of full price sales happening in the same quarter. So there's a couple of headwinds, tailwinds in that quarter, but overall, I'm quite pleased to see that we came out and we maintained our profitability, both in percentages and also on the EBIT took a little bit of a hit. But like I was saying, that was only because of gross margin erosion and also the fact that we started investing in marketing late in Q2, getting ready for our Q3 season.
So does that reverse the last part, Mr. Joseph? Let's stick to Metro now. Does it reverse in quarter three? Is the old inventory stock largely over? And are the marketing spends, the velocity at least, behind you now?
Yeah, so absolutely. The large part of the Fila liquidation is now behind us, right? There's still some small pieces left, but nothing of a significant nature. So that's number one, right? The marketing spends, what we did was we spent more in Q2 this year than we did last year. So now that's going to normalize. Not that we're not spending on marketing in Q3, we will, but then we had those numbers to go up against last year too. But what's really exciting though, Neeraj, is when you look at all the other expenses that we had in our business, we were able to maintain control on them and hence delivered the profitability that we did.
Okay, fair call. Now, what about revenues though? I hear you that the operational metrics may improve in quarter three itself. How has the start of the season, if you will, been thus far? It's about 24 days or 22 days from the time Pitru Paksh got over, though I don't think that impacts sales for products such as yours. But how has the festive season been thus far?
Well, so, this festive season is unique in the sense that both the two big drivers for Durga Puja and Dussehra and Diwali are both earlier this year, right? So what's going to happen is you're going to see a lift in October because both those seasons come in early and they would impact October. So we're seeing that come in very positively and good. But then also in November, where we have as a tailwind there for us is the fact that there are significantly larger wedding dates for both November and December than last year. And that's a big driver to our revenue as well. As you know, in Q1, we were challenged with it because there were absolutely zero wedding days compared to the year before. So we're seeing some good tailwinds coming up in the future. You couple that with the fact that we have deep operational rigor and financial discipline, I'm confident that, we would be able to deliver to the numbers that we've always guided to.
Okay. Foot Locker was supposedly a big thing and probably still is, but they have now an additional tie-up as well, I believe with Nykaa. Is this a negative? How do you characterize this?
So first of all, I think it's very exciting that Foot Locker launched in India.
Of course.
It's a great day for all of us to start having access to global brands in a different way. They're the only multi-brand retailer we have in the country that sells premium athletic footwear. So that's very exciting. The other thing that any retail brand needs to do is to ensure that they have both a digital presence and a brick and mortar presence, right? So we coincided both of them on the same day. And Nykaa are great partners for us to do that with. They have a great reach. They have a great footprint in the country. So I think it's a very exciting partnership where we're able to leverage two best-in-class operators. You have Metro, that's an absolute best-in-class when it comes to retail brick and mortar, and you have Nykaa that does extremely well in the digital space. So it was a very successful combination of partnerships, a unique one, both for Foot Locker, and I don't think we've seen too much of that in India. So it's a unique one that creates actually a lot of good synergy.
Okay, interesting you talk about that the thing is us, Mr. Joseph. Good to see that. But you don't foresee that it will take away some of the sheen that might have happened if it was an exclusive partnership with you?
Listen, what we're keen about is, are we taking care of the customer as best as we can, right? It's not about sheen and shine. It's not about proprietary or not. What we want to make sure is that the consumer has a seamless experience, both, for our Metro business and for our Foot Locker business, both digitally and offline. And we feel that that's been accomplished with this move.
Okay, fair call. Now talk about your own presence, right? You are, I'm presuming, ramping up some of the e-commerce sales as well. There is also joined at the hip to that is the performance of the revenue per square foot trend for you, which if I look at it in a slightly micro fashion, over the last 3 quarters, the numbers have come off a little bit. 4,800, I believe, in Q4, FY24. The last reported number, if I'm not wrong, is 4,300.
Right, that is correct. Q2 is our lowest quarter for a lot of our metrics, right? It's just the nature of the retail business. That's number one. Number two, we've also seen our penetration into tier 3 cities go from 15% to 16%, right? Now, I know that just seems like a small number, but when you're talking about 850 odd stores, that's a significant move, right? Tier 3 cities don't come in at the same sales per square foot. So as we expand, it takes a while for those stores to mature. We don't expect our sales per square foot to tail off in any way, but we have that little bit of the launch, the rollout impact happening. And when you have a low quarter like this, it wasn't, while we recovered very well compared to Q1, it's not where we would normally post our numbers. So you're going to see some of that happening.
Last couple of questions, Mr. Joseph. How would things shape up? So 2-part question rolled into one. One, I heard you say that there are some exciting days ahead. I was speaking to some other retailers who were saying that the next 2 quarters will probably have the highest number of wedding dates, maybe until May 2025, but we'll have the highest number of wedding dates that India has seen in a particular wedding season. So does this augur well for you? Part 1 of my question is that. And part 2 is, do you complement that via heightened store additions as well? Because if I'm not wrong, you've done about 20 in quarter 2 gone by. Is that in line with what you had thought of? Is it lower? And do you expect to expand that number?
Yeah. So a couple of things one at a time. I think you're absolutely right on the wedding dates. It speaks very well for the future of our business when we have more and not only more wedding dates, but also spread over a period of time, right? And that actually goes on all the way through July, Neeraj, of next year, not just through May. The propensity of wedding dates compared to the year before. We actually have wedding dates in July of this coming year, which we had 0 in the year we're in right now, right? So that's definitely what we're very confident and optimistic that it speaks well for our business. It's not about being optimistic about business. It's about understanding the consumer for us and then matching your expense lines and your investments in line with that. We did open 20 stores this quarter net. We have opened 45 stores for the half so far. We've guided to doing between 200 and 225 stores over 2 years, which would put us at the 100+ range each year. And we're confident we will achieve that in the coming quarters.
Okay. Mr. Joseph, when I look at what you've done from March 21 to March 24, right? From 800 to 2400, that's nearly a 3x jump over 3 years. The trailing 12-month numbers much better than what you did in March 24 as well. What is the medium-term outlook that you have for Metro Brands? Do you reckon? I mean, it may be a formal target which I may have missed. Then excuse me. But if there is not a formal target, then just informally, do you reckon that with the business space that you are in and the way India is growing, that doubling every 3-4 years the top line is a possibility?
I love forward-looking statements. We've guided Neeraj to the fact that over a period of time, when you look at a 5-year CAGR, we will be in the 15 to 18% range. So right now, even after a couple of challenging, lumpy quarters, we've had probably four quarters of lumpy sales. We're still trending over 14%, right? We're confident that over a period of time, when you look at the long-term horizon, that's a number we're very comfortable guiding to, given the strength of the Metro brand business. Under all its different banners, given the growth of India, given the move and shift to premiumization that Metro plays really well in. So we're pretty confident about those numbers as we go forward.
Yeah, and viewers, I should apologize to Mr. Joseph in some sense, because you can't take a low base of FY21, which is impacted by COVID, and then look at the growth over 3 years and then try and extrapolate it. But 15 to 18% number, Mr. Joseph, is that what you were saying that you will probably hope to do over the next 3, 4, 5 years?
That's correct.
Okay.
That's absolutely correct, Neeraj.
And last question, you won't need any serious equity fundraise to do your expansion plans, or is that something that might happen?
No, we're very fortunate. The way we run our business, we generate a lot of cash in our business. So it's not a question of having the capital to invest in businesses. But, Neeraj, we're also strategic about how we invest, right? So last year, the year before, you saw a lot of retailers grow their stores, expand very heavily, right? All that does is spike up rental prices. So we decided to just slow down just a tad. And I believe in the last couple of quarters, we've seen other retailers do a net closure of stores, right? So those things always tend to also be lumpy as far as rentals go. And when it's on the high side, we tend to slow down a little. When it's on the low side, we're confident enough about the Indian economy. We're confident enough about our business that then we rapidly expand. So we're a little contrarian, but we're confident that growth is there.
Well, wish you all the best for that growth. Mr. Joseph, thanks so much for taking the time out and being with us today.
Thanks, Neeraj.